Should you roll over your 401k or should you just leave it where it is? That's a great question because for most retirees, the wrong move can cost you tens of thousands of dollars in unnecessary taxes, missed opportunities, or even penalties later on. So today, I want to take you step by step through how to evaluate your 401k rollover options, what's smart, what's risky, and what's best for you depending on your situation. We'll cover the pros, the cons, tax traps, withdrawal rules, and investment differences between 401ks and IRAs, and by the end, you have the clarity you need to make an informed decision. So let's cover what happens to your 401k when you retire. When you stop working, your 401k doesn't disappear. It stays right where it is, invested in whatever funds you selected. At this stage, you usually have four options. One, you could leave it with your old employer. Two, you could roll it over to your new employer's plan. Or if you're retiring, you can roll it into an IRA. The last one is you can cash it out. Now, before you start cashing out, there are some tax ramifications, so be careful here. Cashing out is usually not the most recommended because it's going to be very costly tax-wise. Because when you cash out, you'll owe the income taxes on the full amount. And if you're under age 59 and a half, then you'll also have the 10% penalty unless you have something called the Rule of 55. The Rule of 55 is if you retired at 55 or later, you can take out of the 401k distributions without the 10% penalty. However, if it's in an IRA, that doesn't count. Okay, so there's differences there. So the real question comes down to, should you leave it or should you roll it over? Let's look at some reasons why you might not want to roll over your 401k. So before we talk about why a rollover can be beneficial, let's start with when you might want to keep your 401k where it is. This is important because not every situation calls for a rollover, and good planning means understanding both sides. Institutional funds and lower costs is a great reason to keep your money in the 401k. Some large employers offer institutional share classes in the 401k plans, and this is where those low-cost versions of mutual funds exist, and that can't always be replicatable outside of your 401k or in an IRA. So for example, an institutional S&P 500 index fund might have an expense ratio of 0.02%, while a similar retail version in an IRA could be 0.05% or higher. That difference sounds small, but on a $1 million portfolio, that could mean several $1,000s. Number two is the strong creditor protection. 401ks are protected under ERISA law, E-R-I-S-A law, which gives them stronger protection from lawsuits or creditors. If you're in a profession where lawsuits are a concern, say you own a business or work in healthcare, that added layer of protection might be worth keeping. IRAs do offer some protection, but it varies by state and usually isn't as strong as the ERISA protection. The other thing that might be a good reason to keep it is you're still working past 72 or 73. If you're still employed and have money in your current employer, you can often delay required minimum distributions until you actually retire. This can be a major advantage for people who are still working into their 70s, since required minimum distributions force you to take money out and pay taxes on it, even if you don't need the income yet. So if you're working and like your investment options, it might make sense for you to leave it there. The other benefit, if you have it, is company stock and net unrealized appreciation benefits. If your 401k holds company stock, there's a specific tax rule called net unrealized appreciation. Net unrealized appreciation, or NUA, allows you to pay capital gains tax instead of ordinary income tax on the growth of the stock when you sell it. But here's the catch. If you roll that stock into an IRA, you lose that special treatment forever. You can't go back on it. So if you have company stock, make sure you talk to an advisor before rolling it over. All right, so let's now talk about why many retirees do choose to roll over their 401k. For most retirees, rolling over to an IRA is the smarter long-term move. Let's break down why that is. First, you have more investment choices. Most 401ks offer a limited menu of funds, maybe 10, 20, sometimes 30, because they offer multiple different levels of what they call retirement date funds. When you roll over into an IRA, All of a sudden, now you get access to thousands of investment options, ETFs, mutual funds, individual stocks, individual bonds, and even income generating tools like CDs or annuities. That flexibility allows you to build a portfolio that fits your specific retirement needs, not just what your employer happens to offer. If you think about it, you have 10 or 20 options within your 401k plan, and that's for all ages, right? It's not just for people that are in or near retirement. Number two is better withdrawal flexibility. When you retire, your income strategy becomes the most important part of your financial plan. Most 401ks have rigid withdrawal rules, often only allowing quarterly or annual distributions or requiring large minimums per withdrawal. With an IRA, you can set up monthly income, take in ad hoc withdrawals, or even automate distributions to match your spending needs. That flexibility gives you control and confidence. Two things every retiree deserves. Third is you have simplified management. If you've worked multiple jobs, you might have multiple 401ks floating around. Keeping track of all those different accounts with different statements, logins, and investment lineups can be very confusing. Rolling them all into one IRA can simplify your life, and you can manage your risk, track all the performance, and make strategic changes much more easily. It's all talking together, not all on its own. Number four is the great tax planning opportunities. Now, this one's huge, and usually it's overlooked. 401ks are great for saving, but not great for tax strategy. Once you're retired, you want to be able to control how and when you pay taxes on your withdrawals. With an IRA, you can. You can do Roth conversions in low-income years. You could use qualified charitable distributions after age 70.5 to donate directly to the charity you choose, tax-free. Strategically, you can draw from different accounts, such as your IRAs, Roth, or your after-tax accounts, to stay in a lower tax bracket. Most 401ks simply don't allow these strategies. So if you want flexibility in retirement, income planning, or looking at different strategical tax ideas, an IRA can be a much better tool. Now, let's talk about the hidden factor in every rollover decision, and that's the taxes. Taxes are where a lot of people get tripped up because even though a 401k rollover sounds simple, it's not always tax-free. There's a difference between a direct rollover versus an indirect rollover. When you roll your 401k into an IRA, you want to do what's called a direct rollover, which means from institution to institution. That means your 401k provider sends the money directly to your new IRA custodian, either by wire or by check made out to the new firm. If the check is made out to you personally, that's called an indirect rollover, and it can trigger withholding and potential taxes if you don't redeposit the full amount within 60 days. Now, you can only do an indirect rollover once per year. So the moral of the story is pretty much always you want to do a direct rollover. That way you can always do as many rollovers as you want when you do a direct rollover versus an indirect rollover. Now, the big one is usually the Roth conversion. If you're rolling money from a traditional 401k into a Roth IRA, that's a taxable event because you're moving from pre-tax money to an after-tax money account. But sometimes doing that strategically can make a lot of sense. For example, let's say you retire at age 63, but you're not taking Social Security or required distributions yet. You might have a few years of very low taxable income, which makes it a great time to convert part of your IRA or 401k to a Roth while staying in a lower tax bracket. That's what we call a tax window, and it can save you a lot of money in taxes over the lifetime if done correctly. Now, let's compare 401ks versus IRAs. A 401k has limited investment options versus an IRA has virtually unlimited. When we look at the fees, often the 401ks are lower, and when it comes to IRAs, they can vary depending on who you're working with. The tax plan flexibility, obviously the 401ks are going to be very limited. With an IRA, you have a lot more flexibility making conversions, qualified charitable distributions, etc. Creditor protection, you have strong creditor protection with a 401k because of ERISA. For an IRA, it varies by the state that you live in. When it comes to required minimum distribution rules, for the 401k, you can defer if still working. When it comes to the IRA, you must take that required minimum distribution, which must begin by age 73, and that will change to age 75 by 2033. When it comes to withdrawal flexibility, you're very limited in the 401k versus you have as much control as you want in the IRA. When it comes to beneficiary planning, pretty basic in a 401k, and then for an IRA, you can really customize it. Consolidation, with the 401k, you can have one 401k per employer. If it's in an IRA, you can combine all the IRAs together. So as you can see, the IRA wins on the flexibility and control, but the 401k might still win on protection or costs if your employer plan is strong. So let's talk about some real life scenarios. We'll just call this one case one, the simplifier. Tom is 67, recently retired after 40 years of work. He's got 3 401ks from 3 different companies, totaling around $900,000. Each plan has different funds, different logins, and different rules. He finds it frustrating, obviously, because that's a lot to memorize. And if you're like me, you'll forget the password, then you have to click forgot password, go to the email, and then figure out how to get into your email, make sure it doesn't go to spam, find that, and then be able to reset your password, right? So when we think about consolidating here, that makes it a little bit easier because I only have one password, one login. So we helped Tom roll everything into one IRA, no taxes, no penalties, and now he has one clear retirement income plan with diversified investments and monthly withdrawals that fit in his budget, and those withdrawals go directly into his bank account. For him, the rollover was about simplification and control. Let's look at a tax strategy for case 2. Linda, retired at 63 and doesn't plan to take Social Security until 67. She has a 401k worth $700,000. By rolling it into an IRA, we were able to do a partial Roth conversion over the next 4 years, staying in the 12% tax bracket. By the time the RMDs start, she'll have a mix of pre-tax and Roth money, giving her tax diversification and lower required distributions. For Linda, the rollover was about tax efficiency. Now, in this case study, Mark is 60, owns a small construction business. He's still working. His 401k has strong risk protection. Because of his profession and higher legal exposure, he chose to leave his 401k with his employer for now, taking advantage of creditor protection until he retires. For Mark, the right move was not rolling it over yet. There's no one-size-fits-all for the answer. That's why a personalized analysis is key. Now, if we look at the RMD picture, we have to also think about how rollovers will impact your required minimum distributions. As of 2025, RMDs start at age 73 for most people. If you're still working and have money in your current employer's plan, you can usually delay those required minimum distributions. But IRAs don't get that exception. So if you're still working at 73 and plan to keep working a few more years, it might make sense to leave that 401k alone until you retire. However, once you do retire, consolidating into an IRA usually makes RMD management much easier. You can calculate and withdraw from one account instead of several. And if you have Roth IRAs, remember, Roth IRAs don't have required minimum distributions at all, which is another reason Roth conversions can be powerful before age 73. Now, one caveat here is that Roth 401ks do have required minimum distributions. There's a difference between a Roth 401k and a Roth IRA. So a simple fix there is just moving the money from the Roth 401k to a Roth IRA and your problem solved. Now, let's talk about some common mistakes that you might want to avoid. I've seen some costly mistakes over the years when it comes to rollovers. So let's go over a few so you can avoid them. Number one is doing an indirect rollover, where the check comes to you directly in your name and you're supposed to deposit it in your bank, and then you're supposed to write a check to whoever's supposed to get the money. Remember, you only have 60 days to redeposit it, and 20% is withheld for taxes. Miss that window, and you have all that as taxable income. Number two is rolling over company stock without doing net unrealized appreciation planning. If you have company stock in your 401k, talk to a fiduciary advisor or your CPA before moving it. You could lose valuable tax advantages if you roll it into an IRA too soon. And once you do it, it's not reversible. Number three is not reviewing fees. Some IRAs can have higher fees than your 401k. especially if they're full of loaded mutual funds, meaning you're paying commissions up front on those mutual funds, or annuities with surrender charges. Always understand what you're paying. 4 is ignoring tax strategies. Your rollover decision should fit into your broader tax plan, not just investment performance. So, how do we evaluate your situation? Here's how I'd recommend evaluating your own rollover decision. 1, obviously start with your goals. Are you looking for simplicity, better investments, or more control over income and taxes? 2, compare costs. Check your 401k's expense ratio and administrative fees versus what you'd pay in your IRA. Number 3 is evaluate flexibility. Do you need monthly withdrawals? Are you trying to do Roth conversions? Are you trying to do some estate planning? Those are all things you want to check in with your flexibility with your 401k versus an IRA. 4 is consider your age and employment status. If you're still working and over 73, leaving funds in your 401k might delay required minimum distributions. Number 5 is review creditor protection laws in your state. If that's important to you, weigh it carefully before rolling it over. And finally, get professional guidance because everyone's situation is unique and the cost of a wrong move can far outweigh the cost of good advice. So the bottom line, it's all about control, simplicity, and strategy. At the end of the day, the 401k and IRA are both powerful retirement tools. They just serve slightly different purposes. Your 401k helps you build your wealth. Your IRA can help you manage and protect your wealth. Rolling over isn't just about moving money from point A to point B. It's about creating a strategy that gives you more control over your investments, more flexibility in withdrawals, more opportunities for tax savings, and more confidence in your retirement income plan. If your goal is to create steady, tax-efficient income that lasts long, an IRA often is the better choice here or better vehicle to make that happen. If you're wondering whether a 401k rollover makes sense for you, I'd love to help. At CFG Retirement, we offer complimentary 401k rollover analysis where we'll review your current 401k plan options, compare costs, investment flexibility, and tax implications, show you different choices that will impact you and your income and taxes in retirement. There's no obligation, just some clarity for you. So if you'd like to schedule that analysis, click the link below in the description or visit cfgretirement.com and set some time up to get started. And if you found this video helpful, make sure to like, subscribe, and share it with someone who's approaching retirement because chances are they're wondering about the exact same question, whether they should roll over their money or not. I'm Vince Oldry. Thanks for watching, and I'll see you in the next video.